Ladies and gentlemen, welcome. How are you this evening? I hope you are well. This is Christopher Aaron. It is January 31st, 2019. There was a Federal Reserve meeting, and we are going to be looking at how that impacted the markets, especially the precious metals, and what should be shaping up for the metals. It was a rather important meeting. I want to look at some historical context here. We will get into that in just a moment. I wanted to let you know first that there is a link to the free talk that was given at the Vancouver Resource Investment Conference 1 week ago. In that talk, I expressed my strong opinion on what is shaping up for the commodities markets, the entire commodities market, which is inclusive of precious metals as well as industrial metals such as copper and the liquid energy space. So there's a link to that below. You can watch it when you have an opportunity, because this is going to be exerting an influence on the precious metals, and as you know, especially silver over the next several years. I have an opinion that is probably not mainstream. I do think an important bottom is setting up in commodities, but I do not think we are going to be entering a new bull market immediately. So take a look at that when you have a chance. Let's get into it. Now, there was the non-interest rate hike yesterday. Now, the metals responded initially. We can see the surge here in gold on that decision. And it wasn't really about the lack of an interest rate hike. What the metals were keying off of was the Fed toning down its rhetoric about future interest rate hikes. So we'll look at that in a minute. We'll put it into context. The second thing that they mentioned in that talk, the really big point, was that they may consider stopping their bond selling program. Remember, we're talking bonds that they purchased after 2008 with freshly printed money. So they were selling those bonds, thus extinguishing some of their reserves, theoretically extinguishing some of their excess money in the system, and now they're talking about ending that program, which would be inflationary, all things considered. That is why we saw the spike in gold here, about $10 yesterday, although it's giving back some of those gains today, we can see. Let's look at silver, kind of same scenario here, making a slightly new high and now giving back those gains. I do have a rather strong opinion on what is setting up in the precious metals over the next several months, but we'll save that for another time. Let us look at this Federal Reserve meeting. Here's an article that summarizes some of the key findings. As I mentioned earlier, so what we're talking about is they left interest rates the same. This is an important key. And the other major point is this type of language here. We will be patient as we determine, in other words, as the Fed determines what future adjustments to make to the key interest rate. Now, this is different from what they said a month and a half ago, which was that we are still on an interest rate hiking cycle. So a real change in the language. We're looking out into the future. Is this cycle over? And if this cycle is over, I will tell you this right now. Here's the cycle that we are in at the present moment. If this cycle is over here at 2.25 to 2.5 for the key Fed interest rate, this will be the shortest and the most shallow interest rate hike cycle in the history of the Federal Reserve. So we are living through something here. If this kind of rate hike from 0 to 2.25 caused all this chaos in the markets, and think about the Fed for a minute. The Fed's mandate officially is to promote stable prices and maximum employment. They're not supposed to cater to the markets, officially anyway, let alone the financial system. But clearly, are you kidding me? Why did they issue this new language for this meeting? Because look at the chaos in the markets over the last 3 months after the Fed had begun to sell off their bond portfolio. The chaos that caused 20% stock market correction, which we were all over the last few months. So the Fed is clearly speaking to the markets, and most importantly, the financial sector, the big banks, the large international banks. Of course, if you understand this, that one key point, that the Fed caters to the large banks, which own the Fed then many additional things make sense that are happening in the background that don't really seem to click when one is not grasping that key ownership idea. So if this is the end of the present interest rate cycle, okay, if this is what they're alluding to, the question is, so we saw gold rise on the news. It's given back those gains, though, however. And the question is this really good for gold if this is the end of the interest rate hiking cycle? And I have an opinion that is going to be different from what you hear elsewhere, most likely, which is that no, it is not a good thing over the long run. Why? Well, let us look at some of the historical data here. Let us look at the history of juxtaposing the Fed interest rate cycles here, the generational rising cycle, generational falling cycle, and then was this just the end of a stunted cycle here before they collapse rates again? Well, let's see. When does gold perform best? Let's talk about the strongest bull market in gold. Here we are looking at gold in the freely traded era. We're looking at the entire history of gold prices since the abolishment of the Bretton Woods Accord. This move in gold, we're looking at a log scale, this move in gold from 1971 to 1980 was greater in percentage terms than the move from 2000 to 2011. So just keep that in mind. Strongest advance in gold in the history of freely traded precious metals occurring when? During a rising interest rate cycle, not a falling interest rate cycle, as the media would tell you is the best thing for gold. Let us look at the worst bear market in gold history, 1980 through 2000, 2001. What did this correspond with? Did this correspond with, as the media would tell you, rising rates, which are negative, quote unquote, for gold? No. Bear market in gold, falling interest rates. Now, let's look at the most recent bull market in gold, and we had kind of a mixed bag here. You had, this is I think key, the initial part of the bull market in gold was corresponding with a rise in interest rates, right? From 2003 through 2007, 4 years of rising interest rates corresponding with the launch off the bottom in gold, and then a flattening, and the final part of the bull market, the last 3 years or so, 2008 through 2009, and then extending to 2011, corresponding with these falling interest rates. Just keep in mind, the beginning of the bull market here, the major move, rising interest rates. So where are we today? With the cycle that we began in December 2015, this cycle began, I just want to remind you, if you haven't been following this channel for the last 3 years, the cycle began with the first interest rate hike in 10 years. So it was completely opposite to what most people were expecting, where the first rate hike would cause gold to sell off. It actually marked the bottom. And we've had a slow but steady grind higher in gold amidst this grind higher in interest rates. So the question is, if the Fed now backs off, as they are alluding to, and a lot of people are claiming this is going to be good for precious metals, if we enter another falling cycle here, falling rates, that this is going to be good for precious metals. I have my doubts about that, serious doubts. And the thing to keep in mind is, why is it? What is the fundamental backdrop here? Why do rising interest rates tend to correspond with the most significant moves higher in precious metals? The standard reason that the media will give you that this is because, that rising rates are bad for gold because gold doesn't pay interest. And therefore, if rates are rising, people are more inclined to want to keep their money in interest-bearing accounts. The reason why that analysis is faulty is because they're not taking into account the reason why the Fed is raising interest rates in the first place. The Fed would not raise interest rates unless they absolutely have to. They would keep rates as low as possible to support their member banks, basically giving them free money, printing money, giving it to institutions, giving it to the military-industrial complex. They would do that as long as they possibly could, if it were not for the fact that inflation does begin to rear its ugly head. So the only times when the Fed actually raises interest rates is when inflation is a concern for them. And that is why gold responds to rising interest rates, because it's keying off the fact that the Fed is being forced to act. The Fed is not acting proactively. They're waiting until signs of inflation pick up and then they begin to raise interest rates. This is why gold rises in the strongest rate hike cycles throughout history. So once again, don't believe everything you read. This is from a couple weeks ago. This is the mainstream rhetoric that we were talking about. Gold eases on the stronger dollar, and gold is sensitive to rising interest rates, implying that rising interest rates are going to lift the opportunity cost of holding bullion and therefore cause people to sell gold. They're not looking at the cause for the rising interest rates, as I said. So we're going to put a big no in front of that one. Do not believe everything that you read in the mainstream media, please. So that's why this channel is here. We're looking to pierce through some of the rhetoric that's out there, some of the faulty analysis, and try to do our best to look at available data. Make sure to hit the subscribe button if you want to see more videos like this when they are available. There is a premium precious metals service that I want to let you know about, and a key flash update did go out today. I want to make sure, if you're watching this video, if you're subscribed, that you log into the members section, and please watch that video. There is a new service coming out within the next several weeks. That is called Global Market Intelligence. We're going to cover 14 different markets, including many of the other commodities. As I said, find that link to the free video in the at the Cambridge House conference if you want to see my long-term outlook on commodities. This is why I'm launching this service, because I have a very strong opinion on what is shaping up in the commodity markets over the next 10 to 20 years, really. When we look at these historical cycles, we look at commodities that are priced the lowest that they've ever been in the history of the commodity index that we study. This is the lowest that they've ever been. So I think there's major opportunities. You can find more about that on the link for iGlobal Analytics. That is the new website. This is coming soon. Thank you very much for watching this week. Please pay attention to how these metals respond if we get increasing hints of perhaps a backing off in interest rates. I suspect it is not going to be what the mainstream media is telling you it is going to be. I suspect the metals are setting up for something different here. Let's pay attention.